Ryan Reynolds here from Mint Mobile with a message for everyone paying big wireless way too much. Please, for the love of everything good in this world, stop. With Mint, you can get premium wireless for just $15 a month. Of course, if you enjoy overpaying, no judgments, but that's weird. Okay, one judgment. Anyway, give it a try at mintmobile.com/switch.
Upfront payment of $45 for 3-month plan, equivalent to $15 per month required. Intro rate first 3 months only, then full price plan options available. Taxes and fees extra. See full terms at mintmobile.com.
Reality radio for a really great future. We're talking real money.
Hello, and welcome once again to the daily edition of Talking Real Money. I'm Don McDonald. Thanks for listening. I appreciate it. 855-935-TALK is our phone number. That's 855-935-8255 because 8255 spells talk, and it's talking, but what we're doing about real money. So if you have any questions about money issues of any kind, you can call them in, and I'll answer them on the daily podcast, or you can call live when we're on Saturdays from 3 to 5 Eastern time, and we'll answer them there. But either way, we're going to answer your questions. 855-935-TALK, or you can send them in via talkingrealmoney.com, our website that is the all-purpose website that is getting a major redesign here soon. It's just really hard work. It's going to take me a while. Oh, it's always much harder than you think, isn't it? Oh, well. Welcome to the podcast. It's a Monday. And today I got the complete report from Standard & Poor's, the SPIVA U.S. scorecard. This just came out today. We had the preliminary numbers a couple of weeks ago, but I got the whole big, thick thing today. SPIVA stands for S&P Index versus Active. So it's the indexes versus active mutual fund managers. And last year, the S&P 500, which is the big blue chip index, was down 4.33%, 4.38. And that was the first loss for a year in 10 years. The S&P Mid-Cap 400 dropped 11% for the year. The Small Cap 600 lost 8.5% for the year. And how did active mutual fund managers do? Well, if you listen for any time at all, you know they underperformed. Most of them were beaten by simple, cheap indexes. As a matter of fact, now, 2018 was one of those years that was supposed to show us the strength, the power, the skills of active managers. Oh, just give us a down year, they said after the past 10 years of underperformance. Just give us a down year, please. Well, they got their down year. And their down year was the forced yeah, maybe that too, was the fourth worst. I just made a new word. The fourth worst year for U.S. active mutual fund managers since 2001. 69% lagged the S&P 500 or the S&P 1500 composite for the year. That is only exceeded by 2015 when 74% lagged the market. 2011 when 85% lagged the market. And 2014 when 87% lagged the market. And every once in a while, active managers have had an okay year. 2009, only 41% lagged the market. In 2009, 43 in 2013. So that's still a lot who don't beat the market, but it wasn't as terrible over 1-year periods. However, when you go out over extended periods of time, their performance against the indexes really looks awful, which leads you to believe that those short periods where they actually performed decently, more than half beat the market, may just have been aberrations. Because when you look at all of the domestic stock funds in the U.S., versus the S&P Composite 1500, which is the large, mid-cap, and small indexes all combined, over 5 years, 88% of mutual fund managers underperform the indexes. Over 10 years, it's 85%. Over 15 years, it's 89%. It's terrible. They perform horrifically. There's no point. There is, again, no evidence whatsoever that active mutual fund managers provide anything of value to their customers. Nothing. Over 15 years, the S&P composite, the 1500 composite, returned almost 8% per year, 7.93% per year on average. While all of the domestic funds in the country, this is all of them, equally weighted, returned 6.5%. Mutual funds are being killed by the indexes in every single category: large cap, small cap, mid cap, real estate funds. The average real estate fund in the country did 7%, but the S&P real estate index did 8%. And it's over and over and over again. And it's even worse. It's even worse for bond funds. It's terrible. Let me just look here. I had it somewhere. I think there was a bond one. Where did it go? There we go. Government long-term bond funds. 98% of active managers underperform the index. Investment grade funds, 76% over 15 years, underperformed the index. So nobody's winning, even in something as easy to manage as bonds. You can't beat the market. The biggest reason, when you look at the difference in returns, most of the difference in returns can directly be connected to higher fees, the higher fees that managers charge. So let's assume that they all just do equally well. They do as well as the market. They do as well as the market. Their fees are going to turn those returns upside down. They're going to lose because of the higher fees. It just can't work. 855-935-TALK is our number, 855-935-8255. And by the way, you can check the S&P stuff out at S&P Indices, SPINDICES.com. You can see the scorecard there. It tells you a lot. And these things keep coming out all the time. 855-935-TALK. Call anytime, 24 hours a day, 7 days a week. And let's go grab a phone call.
Hello, Don. This is Kevin from Georgia, a longtime listener and a big-time fan of the Real Investing Journal and Talking Real Money. I have a quick question. I'm 44, and I was wondering if you had any rules of thumb for what percentage of retirement savings should be in Roth versus pre-tax. Obviously, I understand that Roth is ideal, but for someone in an effective tax rate of about 16%, should I, over the next few years, convert any pre-tax to Roth, or is there a sweet spot or advantage of keeping some as pre-tax? I struggle with all or nothing sometimes, and I'm looking forward to what you would suggest. Thank you very much.
Thank you very much for listening. Thanks for your loyalty. I really appreciate it. The question, how much in Roth versus how much in eventually taxable or just deferred accounts? Well, my answer is I want as much as I can have in Roths. I'd have everything in Roths because there's just nothing like taking growing money tax-free and taking it out tax-free. You just can't beat it. It's wonderful. If I could have every penny I own in Roths, I would be very happy because there's no downside. You can take it out once you're retired after 59 and a half. But whether to convert or not, whether to convert the qualified assets, the IRAs, the 401ks, and the like into Roths really depends on a couple of things. One, your current tax bracket, and as you said, yours is low right now. That's good. Two, it appears that you're a saver, you're an investor. So what do you expect your bracket will be like in retirement? If you think you're going to pay a little bit more in taxes, plus you're worried about getting hit on your Social Security and the like, you may want to do some more conversion right now. You're in a low enough bracket. Convert enough that it keeps you from creeping up a bracket. that requires a little pre-tax planning. But that would be my only qualifier on it, is convert up to the next bracket. And if you think you're going to be in a higher bracket in retirement, convert all you can without hurting yourself in the short run. Again, I would have everything, though. Everything in Roths if I could. There's no reason to have that magic mix between the two. It's just a matter of where you saved initially and what your situation was then. There may have been times when you needed the deduction of the regular accounts, and now that you don't, Roths make more sense. So I would fund Roths, but I would do a little conversion too. Thanks very much for the call. 855-935-TALK is our phone number, 855-935-8255. If you have a quick question, leave it at that number. I'll answer it on one of the future podcasts. Listen every day. And if you have a bigger question, a lot of people say, well, Don, I didn't know you also now run an investment advisory firm. For most of the time I did my talk show, my national talk show, people kept saying, well, why don't you just run an investment advisory firm? Because you're at least honest. And so I finally did, along with my good friend and partner, Tom Cock, who I've worked with for years. He used to own a radio station I was on. We formed a company called Vestry. And the thing about Vestry is it is one of the few non-pushy investment firms in the world. Our advisors aren't on sales quotas. They're there to help. If you want to become a client, we'd love for you to be a client. But if you just need help, we have devoted this firm to helping everybody. We will help everybody. We won't manage your money for the rest of your life for free, because that would be just foolish. We do have to make a living to keep the lights on and keep these podcasts on. But if you need some help, go to talkingrealmoney.com and click on the button for an appointment with an advisor. You can do an appointment on the phone, on video, on any means you feel comfortable with. And I promise you, they're not going to sell you or pitch you or pressure you into doing anything. There's no cost and no obligation. Of course, if you go like over an hour, we're going to ask that maybe you become a client, or we're going to have to cut it a little short. But then you can always call the show. 855-935-TALK, 855-935-8255. I'm Don McDonald. Thanks for listening.
Talking Real Money. We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That should keep the lawyers happy.